Welcome to this edition of Investors Board Performance Review. I'd like to introduce this crackerjack panel, if I could. Michelle Edkins, who's the Managing Director and Global Head of Investment Stewardship for BlackRock, the world's largest asset manager, overseeing $4 trillion. So welcome, Michelle.
4.9.
To her left is Aisha Mastagni. She's the Portfolio Manager within Corporate Governance Unit of the California State Teachers Retirement System, commonly known as CalSTRS, and it's the nation's largest teachers' retirement fund. And last but not least is Greg Taxon, probably best known as the co-founder of Glass Lewis. He's also a longtime activist investor, currently is the managing member of Spotlight Advisors, who provides strategic advice in complex corporate situations, including public company shareholder activism, M&A, succession planning, board composition, and high-stakes litigation. Okay. So, knowing that, that's as formal as we're going to get. Okay.
Right.
The rest is passing along good information. So, first of all, our first goal is to reinforce positive behavior. Okay. So, my first question, and Michelle, since you're closest to me, I'll start with you.
Sure.
The first question is going to be, what do you see that boards are doing well that we want to reinforce?
I think what we've seen in the last maybe 3 to 5 years is a much higher level of awareness amongst boards of their accountability to shareholders and the need to be accessible to shareholders. And I think that's been brought about in part by much wider adoption of annual elections and through more and more boards having experience, or board directors having experience of shareholder engagement and feeling the benefit of that. And underpinning that, I think you're just seeing increasing levels year on year of professionalism amongst the best directors. They really see that this is an important role where they need to be a perpetual student and engaged in the wider business community so that they can take that back inside the boardroom.
Aisha?
And I'm just going to sort of tag on to that, because I think one of the things, we talk about this wide range of engagement, and I think that there are, especially amongst the small and mid-cap companies, that are doing a much better job in their proxy, really telling their story. Talking about the metrics that they're using, where they're trying to go, and so just overall, from the small caps to the large cap companies, just doing a much better job in the proxy about telling their story and readdressing the strategy.
Well, I think all those things are correct. The other thing I would say is the vast majority of boards and the vast majority of directors do a vast majority of their work really well. And of course, that's not what the Wall Street Journal likes to write about, or Bloomberg or others, and it's not where activist investors spend their time. But we shouldn't forget that we have an amazing capital markets, in this country and in most of the developed markets that manages to allocate capital well, and companies perform well, and it's because of these independent fiduciaries doing their hard work. And the sort of the untold, unsung story are the thousands of independent directors that work really hard every day and do a great job. And we always, of course, focus on the problem companies. And at least, asking the three of us about this question, it's like asking a battlefield physician about how the war is going, or how's the country doing. I mean, we see the problems, but in fact, most companies are very well run, and directors are working very hard on behalf of shareholders in a way that's made our markets very successful.
Yeah, that's one of the challenges that we have. We have to take such a broad brush with these questions. We know that there's outliers on both ends of the bell curve.
That's right.
The good news is, which I certainly would agree, that most people really care about their own reputation and their company's success. So that's the good news. The bad news is we want the one end of the bell curve to be as short and as small as possible. But we know there's always going to be people there that, do not do what they're supposed to do. And
well, like any human endeavor, right? There are always going to be those who underperform, and there's always the bottom, 5% of everything when you force rank. And I think the efforts, certainly at CalSTRS and at the proxy advisors and BlackRock and other institutions, are to try to lift up the bottom 5%, and it's a continuous, process. The bottom 5% today are much better than the bottom 5% were 10 years ago, but, nobody's going to ever be satisfied with the bottom 5%.
Yeah. It's interesting, just two things. First of all, the CAQ had come out with a confidence and trust survey that they do every year. And it was interesting to note that boards of directors, as far as who they trust, who the investors trust, was significantly down on that list, okay? They were right ahead of politicians and regulators, okay? And the interesting thing, they were rated below management. The very people that they were supposed to oversee, there wasn't confidence from investors that they were doing their job. Now, if we'd have taken that prior to, say, 2008, you would have seen a much different scale. But the publicity and the lack of confidence that was blamed on the board of directors for much of what had happened just stuck a dagger, in that. And then you look at PwC study that they do annually that was released yesterday, and you see for the, maybe the 15th year in a row that board members feel that 35% of board members feel that there's somebody on their board that needs to be replaced, okay? So when you look at both that,
I didn't realize I was on that many boards.
There is an uphill, there's still an uphill climb to go, which is a great segue into my next question. And we can't use all our time to answer this question, but my next question is, in a broad brush, what do boards need to improve on? And Aisha, we'll start with you this time.
Well, I want to echo what Greg said, because I think that most boards really are doing a very good job, and I think they're well equipped to add value for their shareholders. But sort of starting off with the PwC study, I really think that there are a lot of boards out there that still haven't addressed, underperforming directors. They still don't know how to adequately address that issue and ultimately remove those directors if the underperformance doesn't improve. And I think that's the one area where boards still need a lot of work.
Greg?
Well, I'm sorry, this is going to sound boring, but I totally agree with that. I think the number one issue in boardrooms today is board composition, is what I would describe. I think directors that are long tenured, no longer adding value, the business has moved in some direction where their expertise is no longer relevant, and yet they stick around. And it's a hard problem because, among other things, directors are in this somewhat enviable position that they get to set their own pay, and they get to renominate themselves, to an election that looks sort of like an election in a banana republic. There's only 6 people running for 6 seats. So the challenge is the sort of self-policing of composition. And I will tell you, as an activist investor and working with lots of activist investors, almost invariably where you find a problem at a company or a company that's not performing well, you focus on the composition of the board, because the question is, why isn't there a self-correction mechanism going on here to fix the problems with management or the strategy or the capital structure or the collection of assets? What's missing? And often those companies have a mismatch in skill sets on the board, or tenures that are very extended, or people who are very dependent on the compensation sitting on the board, even though they don't add a tremendous amount of value or don't appear to be. So there's it's very rare that you find an activist investor identifying an underperforming company and then they say, oh my gosh, but it has a world-class, well-composed board, so never mind. I mean, generally well-composed world-class boards don't end up in the crosshairs of activist investors, and they don't generally end up overseeing continuous underperformance or continuing problems of underperformance, because they help steer the company in the right direction. So the biggest problem, if you will, that I see at companies, it relates to composition of the board.
Yeah, I just want to add something to that. And one of the things that you mentioned was tenure. And I'm not sure that tenure in its purest sense is a problem, meaning there are plenty of seasoned directors who bring history to a board, whose skills have not been outgrown. And that to me only echoes the importance of the board evaluation, that you have to do an analysis of what the contributions are, because there's somebody that could have a couple of years that is just not panning out, and yet you have people like, I remember Bill Seidman, who used to be my partner. He was 80 years old, still sat on 4 boards, but I couldn't ask for a sharper person who's more knowledgeable about the world, who was still on CNBC as a chief commentator. He was an excellent director, but in a tenure sense, he would have probably been moved off some boards. And when CEOs change so often, you don't have this, when you think of tenure, are they getting too close to their CEO? Well, CEOs these days only last, 5 years, 7 years, at the max. So it's not like
any average. There are some who have lasted a lot longer than that.
And I'm saying there still could be those that happen, but refreshment makes perfect sense to me. But what makes the most sense is board evaluations, and if you do it correctly, all those other issues like age and tenure and stuff really should be non-issues.
It's not a numerical exercise. I mean, it's not sort of anybody over X years, ought to go or whatever. But I do think looking at average tenure on the board tells you something about the willingness of that board to accept new people and new perspectives and understand that they're probably facing new challenges or new market, risks and opportunities, and that they need additional skill sets over time. And so where you see a board where everybody's been there more than 10 years, and look, they may all be fantastic, so there are certainly exceptions, but where you see that, it does, and you see underperformance, right? It causes you to worry, certainly, about the board's self-reflection.
There's also the argument, which I think is going to be a more common argument, about making sure that you have younger people in your mix, okay? Because that they're bringing a level of understanding the world that just can't be comprehended by people that aren't working full-time anymore. So, I mean, our discussion just puts the emphasis even more on board evaluations, relative to that. So, Michelle?
One area where I think nearly every company needs to improve, and it's largely the responsibility of the board, but clearly working very closely with management, is articulating the company's long-term strategy, and long-term way out past 3 years, but 3, 5, 10, and the milestones against which the company should be assessed. So many companies say, oh, our shareholders don't understand us. Well, whose fault is that? If you're not telling us what you're doing and how you should be measured against those goals, then it's quite likely that we will be misunderstanding what you're trying to do and holding you accountable to the wrong things. And our CEO, BlackRock CEO Larry Fink, wrote to a large number of the companies in which we're a major holder, asking for this and asking for the board to be directly involved in determining what that strategy is. And some boards are to varying degrees. But the point of that is, our concern is you have these statements from boards, often where they are going through a transition, and they say, we fully back our CEO and the strategy, and then 6 months later, they sack the CEO. Well, that's not a long-term plan. If you don't back the strategy, don't say you back the strategy, and if you do back the strategy, give the CEO time. And maybe sometimes bringing something to a quick end is the right thing to do, but it happens too often. That's why the average, you've got 20 years at this end and 6 months at that end, it makes to the 5 or 6 years. The other thing that's linked to the composition comments earlier, board diversity. The US is still hovering around 19% women on boards. It's now way behind other markets like Italy. And frankly, if Italy can find 30% of their board seats can be filled by women, given all the amazing graduates out of university here, all the amazing women in business in this country, it astounds me that there aren't qualified women around for board seats. And I think we need to be much more innovative about how we define board roles, and it comes to the board evaluation, it comes to defining the role, not the person. And then it comes down to looking outside your normal network. And one of the engagement questions we ask a lot of boards, particularly, or board directors, particularly if we're concerned about the diversity on the board, is what is each board member doing to deliberately diversify their network? It is human nature to hang out with people you know and you already like and who think like you, but that's not diversity. And given all the business challenges and all the macroeconomic challenges we're facing in the business world, we need people who think differently.
If I can just sort of interject a little bit here, I think one of the important things to note as a director and as a company is that you've got different kinds of shareholders. And my experience has been that when I talk to CEOs and board members, they are most familiar with their active managers who, where there's a portfolio manager who's chosen to buy the stock, who stays with the company for a period of years often, but which is intimately familiar with the company's performance and strategy and people down to a level, 1 or 2 levels below the CEO. Goes to these investor conferences, reads all the research, and is deeply sort of imbibed the company's market dynamic approach, strategy, and other things. And those investors are quite a different animal than either, with respect, CalSTRS or BlackRock, and Vanguard and others who own thousands of companies, sort of have to own thousands of companies, are in the business of owning the market, and are necessarily less familiar with each company and each company's strategy and performance over time. And when issues arise and they show up on Michelle's desk, she's got a different lens and a different understanding of that company than someone who's an active manager and has been in the stock voluntarily over a long period of time with intimate knowledge of the company's performance and hiccups and strategy and sort of a nuanced view of the market. And I think one of the challenges for directors and for CEOs is to recognize that the kind of information that each of these investors kind of arrives at a discussion with is very different. And Michelle necessarily can't understand years of history intimately with each company, and hasn't read all the transcripts and hasn't been to the investor days, but she's one of the largest investors probably in your stock, and she needs to know and she's sort of relying on the fiduciaries to have set a strategy and to measure management, and she needs to know that the directors are actually doing that. An active manager is going to have a different set of information and I think more detailed often history with the company, and they're going to approach that conversation differently. So one of the challenges for directors is to deal with all of the different types of shareholders. We like to sometimes lump them all together and say all of your shareholders want this or that, but they're really quite different in their own understanding of the company and of the directors over time and the performance and the future strategy. So when Michelle says you need to have a sort of a succinct statement of strategy and some goals that the board has set out and is measuring companies by, that's absolutely understandable and true from the perspective of indexers and large market participants that own thousands and thousands of companies.
And that's a great segue into our next topic that I want to talk about, which is shareholder engagement. On the show, we've been talking about it for at least 3 years. PwC's been researching it for 3 or 4 years. You guys have been talking how important it is. It's so logical. You can't, all I hear is frustration from different groups of investors that they can't get a chance to see how a board truly operates, okay? You can get a matrix, but we all know that a lot of corporate secretaries handle that matrix, and if somebody, like in my case, a bank president, they would automatically check he's financial, he's a financial expert. Well, I haven't been in banking for 25 years. There's no way that I would be, but I know I would get that check mark in that. So there's just this tremendous need to be a face-to-face so that you can see if a board gets it, okay? And it's amazing how quick you can tell whether a board gets it or not. So I understand the push for engagement. But my question to you guys is, there's a little bit of confusion out there because we've all been very good at pushing that you need to engage as a board. So some boards that don't have anything to really engage about, that recognize this and want to be responsive, want to set up a meeting, okay? And there's people that you want to meet with who are probably not as eager to, set up a meeting. But let's see if we can clarify this. I'm going to start with you two, and then Greg, I'd be interested in your comments, because your engagement might end up being a little different than their engagement. But when do you want somebody to engage, and how do you want somebody to engage? And then what are your expectations once they are there to engage?
Yeah.
I think that's a reasonable outline for us to offer.
Sure. From our perspective, we want to engage with the director when there's something substantive to discuss. And by substantive, I mean when you go into the meeting with an expectation of what you're going to come away from that meeting with. And we are happy to meet with directors, particularly new directors, say a new lead independent director, if the board or the company wants to make sure that we know who that person is and that that director has a sense of our policies, our approach, the way we think about governance and leadership and so on. But we don't want to meet just so you can meet some statistics on how often you've met with your major shareholders. And that's true of management as well as of directors. We truly appreciate that directors have other things to do with their spare time or with their time. And so we want those kind of meetings to be focused. We're very happy to meet when the company requests the meeting, again, if there's an agenda and we know what the purpose of the meeting is. And we fully expect that when we ask for one, the company appreciates that we have an agenda and that we are expecting to get something out of it. And in terms of that outcome, it could be just building mutual understanding. As you said, we want to have a better sense of how the board operates, because from the outside it's looking a little dysfunctional. It could be that we're actually seeking change and that we want to explain that privately so that the board is fully aware of our position and can take its decisions fully informed.
No, and I've heard a lot from directors or companies that want to bring a director to talk to CalSTRS. And at this moment in time, we are accepting all of those meetings, but we feel like we have an obligation, one, to appropriately staff those meetings, to be very prepared when those companies come in to meet with us. And I've heard several times from directors that they feel like this is part of their job now. And I'm with Michelle, though. It doesn't need to be every year. It doesn't need to be, these are very successful, very accomplished people that a lot of times have other full-time jobs. So I understand wanting to get to know your shareholders and wanting to hear directly from them. And I think it's important to build that relationship, but it doesn't need to be every year. And it doesn't need to be, like you said, just to come and meet us. We're happy to do things by phone and conference calls, and I think you can get a lot from those. But I'm with Michelle also in the sense that, in turn, though, when we ask for a meeting, it's generally because we have a specific issue that's a board-level issue. These are things like executive compensation or proxy access or the leadership at the company. We see directors as our representatives in the boardroom, and when we have an issue that's board level, we expect to meet with the director. But this is after generally sort of an escalation over time. It's not like we're jumping on the phone and demanding to have a meeting with the director with every company that we own. It just doesn't work that way.
Is there, obviously if there's a comp issue, you want the chair of the comp committee, because you don't want anybody else sort of talking, you don't want the head of HR or the CEO talking about their own pay.
It's awkward.
Yeah, it's not much value. But are there other expectations of what, like if there's a lead director or the head of the audit committee or the governance committee, are there any expectations on your side when you have a meeting of who should be present?
As you said, it depends on what the issue for discussion is, and that's why there should be dialogue in advance about what that is, so people do come prepared, both on the company side and our side. But it is fielding the right person. So there's no point in a boardroom having one investor-ready director, because if that person isn't the one we asked for, then you're kind of a little bit hamstrung. We would usually ask to see nominating and governance committee members as well if we're concerned about the appointment process or the board composition, including things like turnover.
Same, Aisha.
Absolutely. I think that for most boards, not everybody has to be sort of investor ready or camera ready, as we call it, but I think you have to have more than just one person. And sometimes it is nice to have, if there's a really, sort of, crisis situation, it would be helpful to have more than just one director in the meeting.
Has anybody brought their whole board?
We have presented to whole boards
Yeah.
at the company's request,
Right.
not because we asked for that, but
Right.
because the company wanted to put forward to their board the way that investors think. And one of those meetings we did with someone from my team representing our stewardship approach, someone from our active equity team, which were also holders, and someone from our corporate credit team. And so we talked about the spectrum of that company's interaction with our firm.
Yeah, I think that's a great, talk about board education. There's probably nothing better than, having one of those sessions in front of the whole board. So Greg, your shareholder engagement can be a little different, sometimes. I'm not saying that you might send a little bear hug letter, at times when you were active in investing, but talk a little bit about your expectations, because you come at this from a little different angle.
Well, I think as an activist investor, when things get escalated to the point where the activist is asking to meet with the board, I've seen two mistakes on either end of the spectrum, frankly, from issuers. One is to hide the directors, which is a mistake. But I've been involved in situations where the company says, I'm sorry, our directors don't meet with shareholders. They're unavailable to you. Send all your correspondence, through the CEO. We're happy to read anything you want to write. And my reaction to that, and it's not just mine, but the reaction I think of activist investors generally is, hey, wait, these people are our fiduciaries. We're owners of the company. They're supposed to be here to serve our interests. What do you mean they won't meet with me? How are they to know our views and represent us well if they won't even take the meeting? So that's a mistake. I've also had the mistake, if you will, on the other end of the spectrum, which is to have a company say, oh yeah, you can come see the entire board, and the board's not ready, for that conversation. And I'll tell you, I'm not particularly proud of this, but as an activist investor, what you do in that session is you pick off the weakest, animal in the herd. So I was involved in a situation like this with a mining company, and there was a director who was an elections lawyer. He was a litigator. And I walked in the room really not knowing much more about them than their bios, but I thought, boy, I bet you this fellow, doesn't have as deep a background in the company's strategy and can't talk about the capital structure and can't talk about the M&A deals and can't talk about the mining environment as well as some of the other directors. So I'm going to sit right across from him. And I directed all of my questions, to that director. And he wasn't camera ready, right? So the other mistake you can make as an issuer, right, is to either offer up directors who aren't ready, or the entire board, assuming there are some people who aren't ready for those engagements. And I think one of the things to know certainly about activist investors are a little like Donald Trump. I mean, the mic is always hot, right? So every interaction with an activist investor by any of your directors, by any of the management team, anyway, you should just assume it's sort of on the record that foibles will be repeated, broadly and widely, and if your directors sort of fumble that interaction, it will inure to your detriment, going forward. So you need to be ready, and they need to be conversant in the company's strategy and history and approach, and why they support what they support, and why the management team is doing what the management team's doing, and so you got to pick carefully kind of which directors you are ready for that interaction, and make sure that they can handle being in a hot mic situation, which these meetings are.
So for the sake of reasonable time, I'm going to ask my last question of you guys, but it's sort of open-ended in the sense that I want you to sort of gaze into the boardroom and give us some thoughts about what you see evolving in the boardroom. What changes are we going to see? What should boards be prepared for? Because this is something moving down the tracks, you know, et cetera. And Aisha, I'm going to start with you. I'm going to finish up, Michelle, with you. Okay, so.
Well, I think, you know, I'm going to go back to what we sort of started this conversation about, and it's really focusing on the composition of the boardroom and who's inside the boardroom. I've said recently that I think sometimes this pendulum of independence has gone almost too far, because I think now you have a board that oftentimes is, you know, management captured, in that there's no one really inside the boardroom that knows those businesses and knows how that industry operates. And that's always concerning to me as an investor. And it sort of ties into this whole issue about tenure and people that may have worked in the industry, but they worked in the industry, you know, 20, you know, years ago. And so it's really looking at the construct of your board, you know, making sure that not only do you have a diverse range of skill sets, but you make sure you have somebody in that boardroom, and at least, you know, 2 or 3 people in that boardroom that really know the business and knows how it operates, and not how it did 20 years ago. Because even, for example, like a consumer products company, you don't market like you used to, you know, even 5, 10 years ago. I mean, with social media and everything that's going on, I mean, you really need someone that has current expertise in that business, and that can see it from a different perspective. And so I think that there are new risks that are posed to companies, but there's also a lot of new opportunities. And so just focusing on who's in that boardroom is just going to be so important going forward.
Greg, how about your
I'll try to
look
be
into the
brief.
crystal ball?
Yeah, so my firm is called Spotlight Advisors because I think that directors, independent directors, are increasingly in the spotlight. And before it was a role that was sort of, you know, behind the scenes, and you know, people didn't really know what was happening in the boardroom, and board members were not being called on the carpet when things went awry. That's no longer the case. You know, today board members expect that if the business goes sideways, or the strategy doesn't work, or the CEO doesn't perform well and they don't do something about it, or they arrange pay structures in a way that misalign interests, that they themselves, the directors, are going to be called to account and are going to be in the spotlight. And so I think, you know, the future board, if you will, 5 or 10 years down the road, is going to have to be a truly independently thinking body that can contemplate broadly the strategy, the capital structure, the collection of businesses, the compensation arrangements, all of these issues that eventually, you know, if they go wrong, right, are going to be sort of laid at their feet as directors. And so I think there's going to be a desire. I think the job is going to get more intense, going to be under more scrutiny, is going to require additional resources and time, and ultimately is going to, you know, really involve probably needing, you know, help and outside assistance and more independent thought. I think it's going to become an ever more kind of serious endeavor, requiring more independent thinking and independent resources. Because I think at the end of the day, these are very accomplished people, and, you know, their reputations are now much more on the line than they used to be.
Well, all you have to do is think of risk management today and how conceivably anybody would get their arms around, and that was before cyber risk. You know, now with cyber risk, the responsibility of overseeing risk management is almost incomprehensible. I mean, that's how big it's gotten. So there's no question there's a challenge. So Michelle, you're in the spotlight right now, and BlackRock is, you know, just such a leader, you know, in investing worldwide. So tell me, when you look into your crystal ball, sort of what you've already mentioned, the diversity and how that issue. So what else would you look at?
I think it's some other things that have already come up in this panel. I think boards are going to get younger. They're definitely going to get busier. I think we're going to have to, as investors, be comfortable that directors draw higher fees because they won't be able to be on as many boards. I think directors should be expected to be scrutinized for the non-public company commitments they have, because while many are now quite disciplined about keeping their public company commitments to 3 to 4 boards, a lot are very, very involved in other areas of their interests, which are particularly time-consuming. And I think we'll just continue to see this being a professional role where you have to be, as I said earlier, a perpetual student. You have to be coming to things like this. You have to be continually scanning the horizon for what might be the next issue for your company or the various companies you're on the boards of. And I think the discipline is on the board, or the requirement is on the board to self-regulate. This result that's been pretty consistent, I think, in the PwC study, that about a third of directors, maybe pushing a bit higher now, believe there's at least one person on their board who shouldn't be there. Then why don't those respondents act on that? Because one of the most critical characteristics of a director, in our view, is someone who's not only engaged and informed and therefore knows what is going on and what is right and what should be going on, they'll act when they see it going wrong. Because by the time problems become visible to investors on the outside, most of the time, directors have known about that or had an inkling about it for 12 to 18 to 24 months. And that's when the value gets destroyed, when there's a big public announcement that something has been festering internally for that length of time. And so I think one of the things that we need to be increasingly focused on as investors is the board evaluation process. And is the board asking itself, did we act soon enough and did we act in the right way?
Well, I can't tell you how appreciative I am on all your views on this. This is exactly what we were trying to pass along. And audience, would you join me in thanking this great panel?